Good morning, everyone. We'll be starting in a couple of minutes. Just a quick sound check, though. If you can hear me okay, could you please type a 1 into the chat window? Thank you. Okay, perfect. I see a couple of ones. Yep, we'll start in a couple of minutes. Okay, let's get started. Good morning and welcome to today's Tuesday Market Outlook session. My name is Prakash Vijayana. I'm a senior analyst here at Options Play, and today I'm going to be walking you through how I am viewing the current markets. So before we get started, as usual, just a quick disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. Our agenda for today, kicking off with the major indices, highlighting some key areas of support and resistance. We have seen some very bullish price action after last week Thursday's inflation reading. And we have seen many, not just individual names, but the major indices as well, breaking above minor and even major areas of resistance. So we will be taking a look at that. From there, we'll be moving on to fixed income, commodities, and crypto. We'll take a look at the sector rotational model as well, highlighting which sectors are outperforming versus underperforming the overall market. We'll take a look at some subsectors of interest that I have for you today. And we'll end today's session, as usual, with the bullish and bearish market observations. So starting off with looking at the rate hike probabilities for the next meeting, which is on the 14th of December. So last week's inflation announcement really had a big impact here. We have a current target rate at 375 to 400. That's where rates are now. And a 50-point hike on the 14th of December meeting would move rates to 425 to 450. A 75-point hike would move rates to 450 to 475. And a week ago, last time we chatted, this was at 50%. So it was pretty even pegging between a 50-point hike and a 75-point hike. But since then, especially after Thursday, we saw a huge jump in the probability of a 50-point hike. This was because inflation came out better than expected or lower than expected. And obviously, with inflation being such a headwind for or inflation and high interest rates, or the prospect of high interest rates being such a headwind for equities, the fact that inflation actually came down lower and had a positive impact on equities, because that tells us that the Fed most likely will only be looking at a 50-point hike now that we have proof that higher rates are actually working on reducing inflation. So definitely some positive news after really what's been months of having this concern with inflation and inflation consistently coming out hotter than expected. The fact that it hasn't, well, we're now seeing a higher probability of a 50-point hike as opposed to that 75-point hike that we've been getting the last few months. And like I said before, that is having a positive impact on equity. So if you take a look here at the S&P 500 or the SPY ETF, we can see here price did manage to break above that key area of resistance at 381. This is the area that we've been talking about for quite a few months now. And that was a strong enough fundamental catalyst to see price break out of that level, heading towards the next key area at around 404. But if we look at the weekly chart, we might actually have a more stronger upside target of 418, which is a 23.6 fib level from pandemic lows. And that is a pretty significant rally, or potential rally, when you consider the fact that, a few weeks ago, price was at the 50% fib level, now already looking like it could even reach that 23.6% fib level in the months to come. But that is a big question as well. It's natural to see some upward momentum with inflation coming out better than expected. But are we going to see that same recovery that we did when we hit pandemic lows? My gut feeling is no. And that is simply due to the fact that we're still in an interest rate hiking environment. That means monetary policy is quite tight. And because of that, it doesn't really facilitate that much room to the upside, or that much momentum for the upside for equities. Instead, we might just see a grind higher. And for that reason, I wouldn't say I expect to see 418 very soon, but what we could expect is, one, a grind higher, or two, a pullback before a move higher. The one thing that I'm more confident in saying is I do think that 50% fib level was the market bottom. And there was a lot of clues leading up to that, to whether it was a market bottom or not. We had a lot of technical confluences when it came to volatility, when it came to outperformance small caps, when it came to positive divergence. These were things that we've talked about for a few weeks now, indicating that this might be a market bottom. But I did mention we need that one fundamental catalyst regarding interest rates, either lower inflation or a dovish Fed. We needed that one fundamental catalyst to really see an upside break. Well, we ended up getting that on Thursday. So biggest one-day gain in the S&P since March 2020 on Thursday. There's definitely some momentum. Price set to open a little bit higher this morning. I do think 404 would be reached this week. Whether we see that momentum carry on to 418, not sure, to be honest. Let's see how price reacts this week. Moving on to the NASDAQ 100. So with the NASDAQ 100, and the one thing actually I forgot to point out with the S&P and the NASDAQ, I guess, was a positive divergence. So just keep that in mind. We did see the positive divergence at the potential market bottom, where price made a new lower low, but momentum made a higher low. That's a very bullish signal as well. So we'll get back to that a little bit later. And again, we saw the same positive divergence across the board, really, even including the NASDAQ 100. But if we look at the QQQ ETF for the NASDAQ 100, we have broken above this 285 minor resistance level. This did provide some resistance. Price came back to retest towards the end yesterday, already bouncing up higher early this morning. So that indicates, clear breakout, retest, and potentially bounce higher to the 300 level. And always remember, with the NASDAQ 100, it's a lot more sensitive to interest rates hikes and interest rate projections, due to the fact that it has a lot more growth names, a lot of technology names, and these are names that have high exposure to international markets. So a stronger dollar, led by higher rates, that has a negative impact for these technology companies. So the fact that we are seeing the potential for interest rates to slow down, that is a huge boost here for companies in the NASDAQ 100. And the next key area or upside target here would be that 300 level. Has provided resistance in the past, previous area of strong support. I wouldn't say it's provided too much resistance over the last year or so, but it's still definitely a strong psychological level to be made aware of. And looking at small caps, so small caps seeing some very good performance recently. We noted, again, positive divergence, a break above 170, which was the 50% fib level, a break above its exponential moving averages, a pullback to retest, and a bounce high from that area, and a lot of momentum carrying small caps here all the way to that 188 area, which is the 38.2 fib level, where it is experiencing some bearish price action yesterday. We saw an intraday rejection followed by a good move lower, but today already this morning, price is set to open a little bit higher. And when it comes to the fact that, this is fundamentally, this rally is fundamentally driven, you may see a lot of these technical levels become invalidated or break. We very well could see a breakout above 180.80 at the small caps, but it doesn't necessarily mean price is going to reach the 23.6 fib level. But it does provide somewhat ballpark estimates of where we do think price would head to, because again, you're looking at the next resistance level here and another strong psychological level, which is that 200 area here for small caps. So those would be the two upside targets that I would be looking at. Keep in mind, again, not just for the major indices that we're covering today, but all the other names or stocks that you're looking at trading, just keep in mind longer term momentum. A lot of the names are now already approaching overbought conditions. So from a timing perspective alone, it may not be best to enter a bullish short-term trade. You may want to wait for a pullback. However, my thesis overall has definitely shifted after Thursday. This was the outcome that we were hoping for. This was the outcome that we've discussed. It was just a matter of time. And now that we know that inflation is coming down at a rate that we're happy with, I believe that, from shifting to a very bearish thesis, I'm shifting more towards short-term bearish or short-term neutral to bearish, because look, one, prices will approach overbought conditions very quickly given the momentum here. And for that reason, from a timing perspective, I don't really think it makes sense to enter bullish options trade, but longer term bullish, because now that we have a market bottom, we've had a significant decline across the board for equities in general, and this provides an excellent opportunity. An opportunity that really only comes around once every couple of years, but it provides an excellent opportunity to start loading up on stocks. And I'm talking about the shares, the underlying shares itself, not options, but loading up on stocks and looking at that longer term investment horizon. I do think now is definitely the time to be doing that, even if not a few weeks ago. And now that we have some upside potential, I think we need to do it with more urgency, if anything. So, now is definitely the time to gain exposure gain bullish longer term exposure, because even if prices now in the short term approach overbought readings, overbought conditions, and there is a short term pullback, it's going to mean basically nothing come 5-10 years time, depending on how long your investment horizon is. So I definitely think now is that time to look at those longer term opportunities. Right, taking a look at small caps versus large caps. This is the ratio chart that we were talking about last week, and the fact that we were seeing a breakout for small caps relative to large caps. For those of you that did miss it, basically, what we see before bull market or a very bullish run is outperformance in small caps relative to large caps. So this is a chart of IWM against SPY, and you don't have to worry about the numbers on the right. All you have to worry about is whether it's moving higher or lower. And if it moves higher, it means that small caps are outperforming large caps. If it moves lower, it means that small caps are underperforming large caps. And during the pandemic recovery period, we had a very impressive run for small caps. And we can see that here in this chart, where small caps had a strong outperformance relative to large caps. And then for almost a year, that died down. So that performance pretty much declined, or relative performance, I should say. And this was during a time when small caps were consolidating for pretty much an entire year, but large caps, they continued to rally. We saw the S&P and the Nasdaq 100 continue to find momentum and rally. And for pretty much most of this year, we've seen this relative chart capitulate almost, and we are seeing a breakout again. So that is another very positive sign here for equities in general, indicating there could be a bullish run on the cards. I don't believe it will be as bullish as it saw during the pandemic recovery period, again, due to the fact that tightening monetary policy, but there is still some potential here. And if we take another look at the VIX here, another confluence that we've been talking about the last few weeks, is that the VIX has been trending lower, and trending lower now for multiple weeks, back below 30. moving averages are crossing over, heading well towards that 20 area. So not only does this provide less correlation and less systemic risk, allowing you to diversify better, but if you take a look at the VIX in the last few weeks, even on days where the S&P moved lower, the VIX moved lower as well. And usually, most of the time, there's an inverse correlation where the VIX will move higher when the S&P moves lower. We have not been seeing that. And that, traditionally speaking, again, a very strong signal for reversal, which is what we are currently experiencing, in my opinion. So again, multiple confluences here that were leading to, or multiple technical confluences that were leading to potentially a market bottom, but we did need that fundamental catalyst, which is why I've been stressing about that so much for the last few weeks. And thankfully, we got that last week. All right, taking a look here at TLT, the bond ETF, bonds starting to find some life, if I can say that. On the daily time frame, price breaking above that 21-day exponential moving average. And I'm really looking at the weekly time frame as potential areas here. The next one being at 102. So this simply has to do with the fact that yields won't be rising with as much momentum as opposed to before the inflation announcement. And we are seeing some reprieve here for TLT, which moves inversely with yields. So I do expect a slight move higher, but look, we're still in an interest rate hiking environment. There is still some potential for further downside here, but price between 89 and 102, those are the two key areas to be looking at. And moving on to the dollar. So obviously with higher interest rates, with interest rates not being as aggressive, or the potential for them being less aggressive due to a lower inflation reading, we have seen the US dollar tank in the last few sessions. Incredible rally all the way to 114 in the last few months. Saw a period of consolidation that lasted a few weeks with 110 acting as support. Eventually, the price broke below that, and it actually even broke below the 107.50 area of support, or 108 level of support as well. So a lot of bearish momentum here, and price does look like it's heading very quickly towards that 105 area here for the US dollar. So that will be the next key area to be looking at, would be at around that 105 level, because if price breaks below that, it's pretty much a free fall back down to 100. And the one thing I will say is, all of this price action and this shifts in sentiment and rotation, even if you want to call it that, that's all happened because of one inflation announcement. Yes, it was a big one, but let's not forget it's still only one data point, and we do have another inflation reading before the next Fed meeting in December. So that's just something to keep in mind, because if inflation comes out hotter than expected, that's going to cause mass confusion, mass uncertainty, and we know that equity markets do not like uncertainty. So because you can't really price it in. So that's just something to keep in mind regarding inflation. And I don't think we should get too carried away here with this risk on shift that we've seen over the last few days. So let's just wait for more data and potentially wait for any pullbacks or retracements before entering any bullish or bearish trades. Anyways, moving on to gold. So gold moving inversely with the dollar, and gold finding quite a lot of momentum. We saw price breaking back above this major support level at major support to resistance level at 157, 158, finding a lot of momentum and looking like it could head to 167. The one thing to keep an eye on though is momentum, longer term momentum already on a daily time frame, already at an overbought condition. So not a good time to enter a bullish trade on gold. What I'd be looking for would be a pullback, potentially back to that 161 level. And from there, that would open the door for much better risk to reward entry for that 167 upside target. But yeah, my thesis for gold got wiped out after the inflation reading. I was expecting price to continue to decline down to 147. Looked like it was heading towards there, but price did find some momentum after the inflation reading. Shifting our focus onto oil, and honestly, there's actually not too much to say about oil. Oil is still very choppy, very much consolidating. Supply and demand balance is very much equal. right now. And it's very difficult to trade, I think, oil companies in general. Yes, they are benefiting from that systemic rise in equities. But if you remember over the last few weeks, whenever we looked at the sector rotational chart, which we'll look at in a second, energy was the strongest sector in the S&P for pretty much the most of this year, but also in the last few weeks. And we are seeing a lot of rotation out of energy because oil is not moving higher. There's a bit of a headwind here for oil. And because of that, because of the choppy price action, we are seeing relative momentum get depleted here for energy. Not by much, but the signs are there. And taking a look at Bitcoin. So the crypto market has been in the forefront of the news lately due to the FTX saga. And that is naturally playing in price or acting as a headwind for crypto. Bitcoin breaking below a very strong area of support at the 78.6 fib level at that 18,000 area. Significant decline here, especially in a matter of a few days. There was a retest, a failed retest to the dot and continuation lower. Now, price is finding some support at around the 16,000 level, but we are seeing a lack of momentum. Yes, price is oversold. I don't necessarily believe that it means the price will shoot back up. What we could see is potentially another retest here of that 18,000 level before a move lower. So we could either get consolidation between that 18,000 and 16,000 level, or even a move lower back to the next major area of support, which is all the way down at 12,000. So that is a significant decline. I don't want to guess which way price will go, but thesis is still neutral to bearish. And for that reason, look for a retest back to that 18,000 area. And I think from there, I'd be very surprised to see price actually break back above that level anytime soon. Okay, taking a look at the sector rotational chart, we have 6 sectors in the improving and leading category, 5 in the lagging and weakening. 6 sectors in the leading category, or the 5 sectors in the leading category are energy. And like I said, even though it is providing leadership, you can see there is a bit of a dip in the relative momentum. We have financials, healthcare, industrials, and staples. So our 2 defensive sectors, healthcare and staples, finding some rotation. Let's see if that lasts, because obviously with the risk on shift, we tend to see rotation out of the defensive sectors and back into the more risk on sectors like discretionary, technology, even communications to an extent. So let's see if they can maintain that momentum. Nothing in the weakening category, because discretionary actually managed to move into the lagging category. But again, I do expect to see a bit of an upward tick here in relative momentum over the next few weeks. We have utilities, still strong underperformance. Even though it's a defensive sector, it's underperforming due to the fact that municipal bonds are not as attractive because of higher interest rates. We also have communications still in that lagging category, real estate and technology still quite weak, but showing signs of life after a few months. Materials is the only sector in the improving category. All right, and taking a look at some subsectors here, we have DRIV. This is a name that we looked at last week, and I am repeating a lot of names that we looked at last week just to give you an update. So my original thesis here for DRIV was bearish. Bearish because 22 was acting as resistance. That thesis was holding up until, of course, Thursday. We saw a breakout, and therefore that thesis has now become invalidated. But, this does provide a nice bullish opportunity, if anything. So what I'll be looking here for DRIV is a retest of that 21 or 22 area, bullish price action, and potentially a move higher. Next key area to look out for in terms of resistance would be at 25. So if we are looking for a move to 25, wait for a retest to that 22 area, and then from there, you'll just get a much better risk to reward bullish entry point. And taking a look at SMH, so DRIV, the ETF that we were looking at before, actually has a lot of semiconductor names. And semiconductors has found a lot of momentum, which is why I've also shifted my thesis here for DRIV, because I believe that the semiconductor names could initially drag down DRIV, but now we are finding that momentum here in semiconductors set to open even higher this morning. Price is at a pretty critical area here at that area between 225 and 216. This area has acted as support in the past, but further resistance could also be found at around the 246, 250 area on the daily. So it does look like price is heading towards there if this momentum can continue. The one thing I will say though is momentum is a little bit overbought. Definitely not an ideal entry point. Wait for a bit of a pullback before looking for any bullish opportunities. In the medium to longer term though, I'm still less optimistic about semiconductors due to the fact that we're restricting trade with China. That's a huge market that we're missing out on. Naturally, that's going to be a headwind for semiconductors. And taking a look at IBB, which is a biotechnology ETF, I had a bearish thesis originally, but it was on my watch list because we saw a pullback here. I was hoping for a rally towards 133, 134. That will give an ideal risk to reward bearish entry point. And we have price is slightly breaking above it. I wouldn't say that's a clean break. We saw a strong rejection of 136 yesterday. Well, does that really shift my thesis? I think it does, because I don't know if I want to be bearish on a sector like IBB or industry like biotechnology. Even though price is at a major resistance level, I'd only look at a bearish opportunity if the weekly close is below that line. If it doesn't, I'd probably look for maybe a bullish opportunity back up to that 143, because let's face it, like, we are in a risk on environment now. This biotechnology, that's going to be a very attractive name for a risk on environment. So that's why I would say I've definitely shifted my thesis again here for biotech. Okay, I'm taking a look at a name that we've looked at a few weeks now, Tesla. So Tesla broke below 200, major support level being invalidated. And it did find some support at this 182 area, price moving a little bit higher. Do I think it's a very strong area of support? I don't really think so. There's a bounce higher, but there's a lack of momentum in that bounce compared to the overall market. It's not even reaching its 21-day exponential moving average. So for that reason, I don't really view 190 as a very strong area of support. But the interesting thing though is we are seeing positive divergence. If this becomes a new lower low, and this is the previous lower low is here, that means momentum has not confirmed this as a lower low, it's a higher low. And therefore that's positive divergence. Again, traditionally a very bullish indicator. Just something to keep in mind of. But as for now, though, in terms of potential neutral to bullish ideas that I originally had for Tesla, I'm not going to be using them. If anything, I'll be looking for a breakdown below 190, potentially a revisit to that 150 area here for Tesla. Because remember, Tesla's valuations are still crazy high. So you just have to keep that in mind in terms of when you're looking at it from a fundamental perspective. Another car company we have is GM. So GM, I do have a nice bearish setup at around this 40, 41 area. We are seeing some bearish price action at a major area of resistance. Price reacted to that area before, and it's once again reacting to this area. Set to open a little bit higher this morning. But if you are looking for a bearish setup, this is the type of idea that or charts that you want to look at. Prices that are at resistance, showing bearish price action. But in terms of the trade structure, I'd probably go for more of a credit spread as opposed to a debit spread, because credit spread, it doesn't need to move that much lower for you to be profitable, or debit spread, it does need to move a lot lower. And I wouldn't say I'm outright bearish here. This would be more of a fade of that 41, 42 resistance area, and more about targeting neutral to slightly bearish price action. Next, we have CrowdStrike. So CrowdStrike, this is a name that I was short-term bullish on, short-term bearish on, long-term bullish on, and it's actually played out quite perfectly. So over the last couple of weeks, when price was in this area between 150 and 160, I was looking for a retest of that 170 area or the 55-day exponential moving average, which we did get, bearish price action as well, and a very strong move lower. And it actually hit our downside target price of 120 almost to the cent. But from there, when I look at CrowdStrike from a fundamental perspective, from a long-term perspective, I do think it's one of the best in class in terms of cloud security providers. And because of that, I said I was long-term bullish on. I was looking for a move to 120 before I start accumulating shares. And we have seen that move now happen. And we are seeing a very strong reaction from the 120 level. But the reason I'm showing you this chart is because there's many charts like this, where there's many charts of stocks that, over the last few years or few months that you may have wanted to own, but we've seen this massive decline. You might have been a little bit scared to get in, and that's completely understandable. But, with that, like using CrowdStrike as an example, I do think now is going to be that right time to get in. Because let's say, for example, even if CrowdStrike moves lower, because I don't necessarily think it's going to move that much higher right now, but even if it moves lower, if your investment horizon is long enough, this move lower means very little in the grand scheme of things. So that's really why I want to focus on CrowdStrike, because this was just an example that I was currently in. And we have lows. So lows, again, a bearish idea. And the reason I have a couple of bearish ideas is actually due to the risk to reward favoring the downside after a very strong rally in the last couple of days. But these bearish ideas are going to be very, very short-term in nature. So on a day where futures are up, lows is actually trading a little bit lower, reacting to the 210 area of resistance. So very bearish price action. I wouldn't say that's an engulfing candle, but it did break previous session lows. And for that reason, I do think the risk to reward does favor the downside here for lows. Next key area of support is at 185, but I'd be looking at around the 200 area as well as a potential downside target. So again, short-term trade setup, but that's how you want to play this market when it's short-term overbought. But we have the potential for capitulation and a move higher in the longer term. And with that, that is all I have for you today. Thank you so much for joining me, and I hope you all have a great trading week ahead. I will see you next week. Goodbye.